think we ourselves have moved on to Australia and Japan as well, because in view of the Jackie's potential expansion, so that's something that a lot of people have been exploring. So I think in terms of where rates are this year, it makes sense to be in government bonds and also high quality investment grade issuers. So there isn't really a great need like what we saw in the past few years to chase for yields. So it's a great, I think, it's a great situation to have. And in terms of, but obviously our choice to be in government bonds is also not driven by choice in a way, because of the lack of issuance that we mentioned about. So I think for next year, we have to see how the expectations of investors and both issuers moderate to the extent where they can agree to issue at the right levels. Because I mean, if you look at the issuers at the moment, they're still pretty much well banked by, in Asia, they're pretty much well supported by the banks. So there's not really a need for them to come out in the market, especially high grade ones.
Danny, I know that you invest in several of the local markets as well. When you think about local markets versus offshore market, what's the dynamics that play out at your firm? When does it make sense? And I guess some of the local markets, which markets in particular have you been active this year?
In terms of where it makes sense, to be honest, I think it depends on the mandates. I mean, because we manage quite across a spectrum of currencies and especially client base. So I think what happens is that we compare the situation of the local currency versus dollar space. I think all in is the hedging. You have to take into account the hedging costs. So right now, if you are a local currency investor, say for example Sing dollar, it's kind of like not that compelling before the current sell-off to invest in dollar bonds because of hedging costs. You're technically losing about somewhere between like 1.5 to 1.7% from the gross yield. So from that perspective. However, if your perspective is from the dollar perspective, dollar-based currency, buying local currency, that makes perfect sense, because it's the reverse. You imagine that you buy the Singapore T-bills or MAS bills at about 4%, and you hedge it in the dollars, you're potentially gaining about like 1.5%, and all in is probably about 5.5%, 5.7%, depending on the levels. And then it's a AAA versus a split rated US situation.